Hello guys, welcome back to Wealthwise Academy. Today I'm going to talk about 7 rules of investing for 2024. When Warren Buffett was 10 years old, he used to go to a horse racetrack called Aksar Ben. He would go there after the races were over and pick up all the discarded tickets left by fans. He figured that someone must have given away a winning ticket, as many people attended the races for enjoyment rather than serious betting. Buffett would collect thousands of these tickets, get drunk, throw them in the air, and then meticulously check each one to see if it was a winner. He knew that no one would give a winning ticket to a 10-year-old, so he gave the winning tickets to his aunt. This early display of patience and reading habits stayed with him throughout his life. When he turned 20, Buffett started his investing career with the Buffett Partnership. He spent his entire day reading Moody's Manual, a book that organized basic financial information about companies in small letters on a single page. In today's world, we have websites that organize company information. But back then, this manual was the go-to source. Buffett believes that the biggest compounding knowledge comes from reading, and he continues to read books and annual reports to this day. The first rule of investing, according to Buffett, is to learn a lot and read a lot. The second rule is to know what you own. Peter Lynch, in his book Beating the Street, shares an example of 7th grade students from St. Agnes School who created a portfolio of 14 companies. Over 2 years, their return was 70%, beating the S&P index, which had a 26% gain. This experiment began after a discussion between their teacher and CEO John Mary C. Both wanted to prove that an MBA, a driving license, or Excel skills were unnecessary for successful investing. The key was understanding the companies they invested in. The students were taught never to invest in a company they couldn't explain with a crayon drawing. When choosing a company, they were asked to describe what the company did, what products or services it offered, and if they couldn't explain it, they couldn't invest. Another lesson the students learned was that for long-term investments, smaller companies provided more opportunities for growth. In a large market like the one Reliance operates in, it's challenging for large companies to achieve significant growth without major changes or new product launches. Therefore, many investors believe that smaller companies can grow more quickly. In conclusion, the strategy of investing in smaller companies can provide more growth opportunities for small investors. As larger investors shift towards bigger companies, smaller investors can take advantage of the potential in the small cap space. The next rule says, hold no more stocks than you can remain informed about. This concept is that the human mind can effectively follow and stay informed about a maximum of 8 to 15 companies. It's better to not take more than 10 stocks throughout our lives. However, those 10 should be such that we feel like we've actually met the owners, signed a 100-page agreement with them, dealt with them, and bought shares by paying them. In short, Warren Buffett also believes that if we find 3 super businesses that are doing very well, an average person doesn't need more than that in their life to succeed. Love it. But 3 wonderful businesses are more than enough for you to do in this life. The next tool of investing says, if you like the product, chances are you will love the stock. Peter Lynch says that in his family, all 3 daughters wore your brand clothes, but despite being an investor, he never thought of investing in that company. The stock price had tripled in a year, but the next time, he was more careful. He took his 3 daughters to the mall and observed what product they wanted to buy. However, this time, he didn't go to the starting point, but visited a shop named Body Shop. There, he saw many women buying lotions and creams, and the store was crowded. The next day, after reaching the office, Peter Lynch ordered the annual reports of the Body Shop, and after fundamental analysis, found that the company was aggressively opening showrooms worldwide, and each showroom was profitable. Therefore, he recommended the stock to his management, and its price multiplied. In India, we see similar cases. For example, if we talk about Royal Enfield's bikes, popularly known as Bullets, the stock price has increased from 1.22 rupees to around 4,000. Britannia Industries Limited started at 58.23 rupees and reached 5,000 rupees. In short, the message is that if we like certain products and the company is financially stable, we can use this method for screening. The next rule of investing says, don't try to time the market. Peter Lynch says that even the experts don't know when the market will rise or fall. Their job is to pretend that they know, so they can freely give advice on what will happen in the market next. The best investors focus on buying good businesses with products that people actually want. Because if businesses are growing, the share price will also grow in the long run. Therefore, it's better to focus on businesses rather than trying to time the market. This leads to the conclusion that everyone's time is different. Timing the market is the biggest debt, the biggest curse, and the biggest challenge for investors. Nowadays, the challenge for investors is not what will happen in the market, but when to go, when to do it. In this, all the energy is exhausted. The next rule says, free cash flow is the king. This point emphasizes that if a company's profit is increasing, but its cash flow is not, there might be something wrong with the company. For those unfamiliar, earnings mean profit. However, the type of profit also matters. When a company publishes its financial report, if someone still owes the company money, meaning the company has given credit to someone and hasn't received the money yet, that amount is included in the profits. This is something that we need to include in our analysis of a company's financial health. Analyzing the company can be confusing. Therefore, Warren Buffett's favorite indicator is free cash flow. To understand free cash flow, let's first understand cash flow. Cash flow is the actual money a company has. Let's take Reliance's cash flow statement as an example. We can see that in March 2018, Reliance had cash of 1,206 crores. In March 2019, it was 3,745 crores. But in March 2021, it is minus 13,523 crores. If we look at Reliance's earnings in the profit and loss statement for March 2021, it is positive at 49,128 crores. However, the cash flow was minus 13,523 crore. To understand the complete story, we need to read Reliance's annual reports to know where the money was spent and what is pending. Cash flow is made up of three things: cash from operating activities, main operations, cash from investing activities, investments in other companies, etc., and finally, cash from financing activities, if they took a loan, etc. The actual free cash flow, which we call the king, is the operational cash flow minus capital expenditure. In other words, if your business makes a profit every year but needs to invest in machinery for the next year, your actual profit might be just 1 lakh rupees, and this is the free cash flow. So, always keep an eye on a company's free cash flow. Now let's quickly revise the investing rules we learned. Rule number 1, learn a lot, read a lot. The more you learn, the more you earn. Rule number 2, know what you own. Understand the company's products and future earnings potential. Rule number 3, over the long term, it's better to buy stock in small companies. Small companies have a higher growth percentage. Rule number 4, hold no more stocks than you can remain informed about. Warren Buffett suggests focusing on a few good companies rather than having a large portfolio. Rule number 5, if you like the product, chances are you will like the stock. This is a good screening test. Rule number 6, trying to time the market is not advisable. Instead, focus on finding good businesses. Rule number 7, free cash flow is the king. Don't rely solely on earnings. Understand the company's free cash flow. If cash flow is negative, read the annual reports and earning calls to understand the true reasons. If you want to start investing in the stock market, you can open a demat account through Angel Broking. A link is provided in the below description. Also, if you don't want to miss knowledgeable videos, subscribe and press the bell icon. We will meet again soon. Until then, goodbye.